Let me start with a question that immediately makes people uncomfortable. If buying a home is always the smartest financial move, then why do so many homeowners feel broke, stressed, and one repair away from a nervous breakdown? Think about that for a second. Because this isn't about feelings, it's about numbers, and the numbers don't care about tradition, social pressure, or what your parents did in 1995. Now here's what's about to happen. In the next couple of minutes, one of two things will occur. Either you'll feel relieved, because something that's been quietly stressing you out finally makes sense, or you'll feel defensive, because this challenges a belief you've been carrying for years. Both reactions are normal. Only one leads to better decisions. So let's set expectations early. This is not a rent forever video. This is not a home ownership is evil rant. And this is definitely not real estate agent content. This is about math, incentives, and why Americans are emotionally manipulated into one of the largest financial decisions of their lives. Let's talk about you. You're in your late 20s, 30s, maybe early 40s. You've been saving. You've been responsible. You finally have a down payment that looks real on paper. And then it starts. Friends who bought 3 years ago start posting photos of their kitchens. Parents casually ask when you'll stop throwing money away on rent. A real estate agent tells you rates might go up, inventory is low, and you don't want to miss out. And suddenly, a financial decision turns into a moral test. Renting starts to feel like failure. Buying starts to feel like adulthood. That emotional framing is the trap. Because no one sits you down and explains what buying a home actually costs in real terms. They just repeat the same sentence over and over. You're building equity. Sounds great, feels responsible, is wildly misleading. Let's slow this down. When you rent, yes, you pay money every month and you don't get it back. But when you own, a shocking amount of money also disappears forever. It just vanishes in quieter, more socially acceptable ways. And that's where the confusion begins. So let's strip the emotion out and look at reality. When you own a home, there are 3 categories of costs that are just as gone as rent. Property taxes, maintenance, and the cost of tying your money up in the house instead of investing it elsewhere. No one likes to talk about those because they ruin the fairy tale. Let's start with property taxes. In the United States, the average property tax rate is about 1.1% of the home's value per year. On a $500,000 home, that's roughly $5,500 a year, about $460 a month. Gone. Not building equity. Not increasing your net worth. Not coming back. You're paying the government for the privilege of owning property. That's rent with a flag on it. Now maintenance. The rule of thumb used by actual adults who own homes is about 1% of the home's value per year. Roof, plumbing, HVAC, appliances. Things that break at the worst possible time. On that same $500,000 home, that's another $5,000 a year. About $415 a month. Also gone. Maintenance doesn't increase value. It just prevents value from falling apart. So before we even talk about your mortgage, you're already spending close to $900 a month on costs that behave exactly like rent. Now comes the part almost no one explains clearly. Opportunity cost. This is where people's eyes glaze over, which is unfortunate, because this is the most expensive part. When you put $100,000 into a down payment, that money doesn't disappear, but it also doesn't grow. Historically, the stock market has returned around 9 to 10% annually over the long term. Homes, on average, appreciate closer to 3 to 5%. That gap matters. If your money could have been earning 8 to 10% elsewhere, but is instead locked into a house earning 4%, that difference is a real cost. It's just invisible. That's the cost of capital, and it's ruthless. Now let's layer in the mortgage itself. In 2026, mortgage rates are hovering around the mid-6% range. On a $400,000 loan, that's tens of thousands of dollars a year in interest alone at the beginning. And here's the part that hurts. In the early years of a mortgage, most of your payment goes to interest, not equity. You're not building wealth. You're renting money from a bank with paperwork. So when people say renting is throwing money away, they're accidentally telling the truth about both options. The difference is how much you're throwing away. And that's where the 7% rule comes in. The 7% rule is a shortcut that cuts through all the emotional nonsense. Here's how it works. Take the price of the home, multiply it by 7%, divide by 12. That's your approximate monthly cost of owning that home in real terms, not your mortgage payment, your true cost. So a $500,000 home, 7% of $500,000 is $35,000 per year. Divided by 12 is about $2,900 per month. That $2,900 behaves like rent. It's money you will never see again. So now comes the only question that actually matters. Can you rent a comparable place for less than that? If yes, renting is financially superior. Period. Not emotionally, not philosophically, mathematically, and this is where people get angry. Because this contradicts something they've been told their entire lives. Let's talk about what's actually happening in 2026. Mortgage rates are high relative to the last decade. Home prices are still elevated. Inventory is tight. Meanwhile, rents in many parts of the country have stabilized or even softened. That creates a rare situation where renting and investing the difference can leave you significantly wealthier over time than buying. Not always, not everywhere, but in many markets. Buying a home makes sense when you plan to stay for a long time. The cost of owning is significantly lower than renting. Or you deeply value the non-financial benefits and are willing to pay for them. What doesn't make sense is buying out of fear, pressure, or shame. And yet, that's exactly how many Americans do it. Because everyone around them is emotionally invested in the idea that home ownership equals success. Real estate agents make money when you buy. Lenders make money when you borrow. Family members feel validated when you follow the script. No one gets paid when you do the math and decide to wait, which is why you rarely hear this explained clearly. Now here's the uncomfortable but empowering truth. Renting is not failure. Buying is not automatic success. Both are expenses. Both have trade-offs. Both can be smart or stupid depending on timing and numbers. The difference is that one comes with less risk, more flexibility, and fewer illusions. And the moment you understand that, the pressure loses its power. Because fear only works when you don't understand the game. In the next part, we're going to break down exactly how this plays out over 10 years, why investing the difference matters more than people think, and why the phrase, "you're throwing money away," is one of the most manipulative financial lies in America. And yes, homeowners will get mad. That's how you know we're being honest. Now let's do the thing most people conveniently avoid. Let's stretch the timeline. Because short-term thinking is the enemy of good financial decisions, and real estate propaganda survives almost entirely on short-term snapshots. Someone buys a home, prices go up, they feel smart, end of story. Except that's not how life actually works. So let's run two parallel lives over 10 years. Same person, same income, same discipline. One chooses to buy. The other chooses to rent and invest the difference. No tricks, no cherry-picking, just math and patience. First, the buyer. They purchase a $500,000 home in 2026. They put down $100,000. They take a $400,000 mortgage at around 6.5%. Their monthly mortgage payment is roughly $2,500. Add property taxes, add insurance, add maintenance. Their all-in monthly housing cost lands around $3,300 to $3,500. Now remember the 7% rule. Their true unrecoverable cost is about $2,900 a month. The rest goes toward principal. Slowly, very slowly. In the first year, a large chunk of that mortgage payment goes straight to interest. That money is gone forever. By year 5, things improve. By year 10, even more so. But here's the part people forget. That $100,000 down payment didn't vanish. It just stopped working. Now let's look at the renter. They rent a comparable place for $2,400 a month. Same neighborhood, same quality of life. No imaginary downgrade. That's $500 less per month than the buyer's true cost. And they didn't lock up $100,000. So what do? They invest the $100,000, and they invest the $500 difference every month. Not in meme stocks, not in crypto miracles. In a boring, diversified portfolio. Historically, that portfolio earns about 8% annually over the long term. No guarantees, just probability. After 10 years, that initial $100,000 alone grows to around $215,000. The monthly investments add another significant chunk. Meanwhile, what happened to the homeowner? Their house appreciated. Let's be generous, say 4% annually. That $500,000 home is now worth about $740,000. Sounds great. But now, subtract reality. Transaction costs, selling fees, capital costs, maintenance over a decade. And remember, a big portion of what they paid went to interest and taxes.
When you run the full numbers, the gap between these two lives is often much smaller than people expect.
In many scenarios, the renter-investor comes out ahead. In others, they're roughly equal. Rarely does the homeowner dominate unless appreciation is unusually strong or rent is extremely high. This is the part that breaks people's brains, because they've been told one path is obviously superior. It's not. The advantage of renting isn't higher returns, it's flexibility and risk control. If your job changes, if your relationship changes, if the market shifts, if life happens, the renter adjusts, the homeowner absorbs. Now let's talk about risk, the kind people ignore because it doesn't show up in spreadsheets. Concentration risk. When you buy a home, a massive portion of your net worth becomes tied to one asset, in one location, in one regulatory environment, with one local economy. That's the opposite of diversification. If something goes wrong in that area, you don't just lose value, you lose mobility. The renter doesn't have that problem. They're exposed to markets, not neighborhoods. Now let's talk about leverage. Leverage magnifies gains. It also magnifies losses. People love leverage when prices rise. They stop mentioning it when prices stagnate. If housing prices stall for a decade, which has happened before, leverage turns from hero to villain. Your capital is tied up. Your opportunity cost compounds. Your flexibility disappears. And all of this is happening while you're still paying property taxes, maintenance, and interest. Now here's where things get uncomfortable. Most homeowners don't calculate returns. They calculate feelings. They feel secure. They feel grown up. They feel validated. Those feelings are real, but they're not free. They're paid for with higher fixed costs and reduced optionality. That doesn't make them wrong. It makes them a lifestyle choice. And lifestyle choices should be made consciously, not under pressure. Now let's address equity, the most misunderstood word in American personal finance. Equity is not cash. Equity is not liquidity. Equity is not freedom. And thus, equity is value minus debt, trapped inside an illiquid asset. To access it, you have to sell, borrow, or downsize, all of which involve costs, timing, and stress. Equity feels powerful because it's abstract, but abstract wealth can't pay bills. Now compare that to invested capital. It's liquid, it's flexible, it doesn't require permission from a bank. You can rebalance, you can pause contributions, you can change strategy. That flexibility has value, especially in uncertain environments. Now let's zoom out. Why does the myth persist so strongly? Because for decades, housing in the US did exactly what people hoped it would. Prices rose steadily, rates fell, wages increased, demographics supported demand. That era shaped beliefs. But conditions change, and strategies that worked under one set of conditions don't automatically work under another. Blindly repeating old advice in a new environment is how people get hurt. Now let's inject some humor, because this topic desperately needs it. Buying a home because rent is throwing money away is like buying a gym membership because sitting on the couch doesn't build muscle. Technically true, practically useless. What matters is what you actually do consistently. A disciplined renter-investor beats an undisciplined homeowner every time. Now here's the key insight. The real advantage of renting isn't money. It's agency. You choose when to buy. You choose if to buy. You choose based on numbers, not narratives. And when you finally do buy, if you do, you'll do it from a position of strength, not fear. In the next part, we're going to talk about the psychological traps that keep Americans stuck in bad housing decisions, how marketing exploits identity, and how to reframe money so it works for you instead of against you. This is where the mindset shift happens. Let's talk about the part nobody likes to admit. Most housing decisions in America have very little to do with money. They're about identity. Buying a home isn't sold as a financial choice. It's sold as a personality upgrade. You're not just purchasing walls and a roof. You're buying adulthood, stability, respect. And once something becomes part of identity, logic loses its authority. Because people will tolerate almost any financial strain if it makes them feel on track. This is why conversations about renting versus buying get emotional fast. You're not questioning a spreadsheet. You're questioning someone's life choices. Now here's the uncomfortable truth. The phrase American dream never came with a balance sheet. It came with imagery. A house, a lawn, a sense of arrival. And for decades, that imagery aligned with reality. Cheap land, rising wages, falling interest rates, expanding suburbs. But systems evolve. Stories lag behind. And people keep following the story even when the math has changed. That's how pressure builds. Pressure from parents who bought homes for 3 times their annual salary. Pressure from peers who locked in low rates before everything shifted. Pressure from social media, where every renovation looks like wealth. But you never see the spreadsheet. You never see the stress. You never see the second job or the maxed out credit cards. You just see granite countertops and assume success. Now let's talk about loss aversion. Humans feel losses roughly twice as strongly as gains. Which means, once someone buys a home, they're emotionally invested in defending the decision. Any suggestion that renting might be rational feels like an attack. Not because it's wrong, because it threatens certainty. This is why homeowners often respond to financial arguments with anecdotes. My house doubled in value. My cousin bought and did great. My rent was rising, so I had no choice. Anecdotes feel safer than averages. But averages are what shape outcomes over time. Now here's where marketing enters the chat. Real estate marketing doesn't sell houses. It sells urgency. Rates are rising. Inventory is low. This is your last chance. Urgency shuts down analysis. It pushes people into irreversible decisions under artificial time pressure. And once the ink is dry, rationalization begins. People don't ask, was this optimal? They ask, how do I justify this? Now let's be fair. Owning a home has real benefits. Control, stability, emotional comfort, the ability to customize your space. Those things matter. But they are consumption benefits, not investment returns. The mistake is pretending they're free. Every benefit has a price. The problem is pretending it doesn't. Now let's flip the script. Why is renting framed as temporary? As something to outgrow? Renting is flexibility. Renting is risk management. Renting is choosing liquidity in an uncertain world. In a labor market that changes quickly. In cities that evolve. In an economy that shifts. Flexibility is not weakness. It's strategy. Now let's address the shame layer. People feel embarrassed to admit they rent, as if they failed an invisible test. That shame is manufactured. It exists because industries profit when people feel behind. If everyone calmly evaluated rent versus buy, transaction volume would drop. So the narrative must stay moral, not mathematical. Now let's talk about comparison. Comparison is the fastest way to ruin good decisions. You compare your rent to someone else's mortgage, your monthly payment to their square footage, your flexibility to their equity. But you don't compare risk, stress, opportunity cost, mobility. You're comparing one visible number to an invisible system. That's not analysis. That's self-sabotage. Now here's the shift that changes everything. Stop asking, is renting or buying better? Ask, what am I optimizing for right now? Security, flexibility, growth, stability, peace of mind. Different seasons demand different strategies. There is no permanent answer, only context. And the moment you stop treating housing as a moral milestone and start treating it as a tool, clarity returns. Now let's zoom out one last time. Money doesn't care about tradition. Markets don't reward nostalgia. And math doesn't negotiate with identity. The people who win long-term aren't the ones who follow scripts. They're the ones who adapt. Which brings us to the final part. Because understanding this intellectually is one thing, resisting pressure consistently is another. In the final section, we'll tie this together. We'll talk about how to make decisions calmly in a noisy system, how to design your environment so you don't sabotage yourself, and how to build a relationship with money that actually feels lighter. Let's land this calmly, not with panic, not with urgency, not with a fake countdown timer blinking in the corner of your brain, but with perspective. Because if there's one thing this entire conversation should leave you with, it's this. You're not late, you're not behind, and you're definitely not broken. You're just operating inside a system that benefits when you feel rushed, inadequate, and unsure. Once you see that, something interesting happens. The noise fades, the pressure loosens, and decisions start to feel lighter. Here's the quiet truth most people never hear. Money problems are rarely about intelligence. They're about environment, about the ideas you're surrounded by, the stories that get repeated, the assumptions that go unchallenged. Most Americans don't wake up and say, I'm going to make a bad financial decision today. They follow scripts, inherited scripts, cultural scripts, scripts written decades ago for a completely different economic reality. And housing is one of the most powerful scripts of all, because it touches everything: identity, security, status, fear. That's why questioning it feels dangerous. But here's the reframe. Questioning the script doesn't make you irresponsible. It makes you awake. Awake people don't rush. They don't panic buy. They don't confuse movement with progress. They pause. They calculate. They choose deliberately. And that's the real upgrade. Not a bigger house. Not a lower rate.
Not bragging rights at a barbecue.
Clarity. Clarity is knowing why you're doing what you're doing and what you're giving up in exchange. Once you have that, guilt disappears. Renting stops feeling temporary. Buying stops feeling mandatory. They become what they actually are. Tools. Tools you can pick up or put down depending on your situation. Now let's talk about peace of mind, the thing everyone pretends housing automatically provides. Peace doesn't come from ownership. It comes from margin. Margin in your budget, margin in your time, margin in your thinking. A person with margin sleeps better than a person with granite countertops and anxiety. Margin lets you say no. Margin lets you wait. Margin lets you walk away from bad deals, and walking away is one of the most underrated financial skills in existence. Now here's something that doesn't get said enough. Flexibility is not indecision, it's preparedness. The future doesn't reward people who lock themselves into rigid plans. It rewards people who can adapt without panic. Careers change, cities change, markets change, life changes. And the people who feel stuck financially are rarely bad with money. They're just overcommitted. So here's the real takeaway. The smartest financial position isn't owning or renting. It's optionality. The ability to make your next decision from strength instead of pressure. Everything we talked about, the 7% rule, opportunity cost, equity illusions, social pressure, it all points to this one idea. Money should reduce stress, not manufacture it. And if a decision increases your anxiety while being sold as the responsible thing, it deserves a second look. Now let's address you directly. If this video challenged you, good. That means you're thinking. If it relieved you, even better. That means you were carrying pressure that didn't belong to you. And if it annoyed you just a little, congratulations. That's usually where growth hides. This channel exists for people who want to think clearly in a world that profits from confusion. No hype, no fear, no pretending complex decisions have one-size-fits-all answers. Just honest frameworks, context, and respect for your intelligence. Subscribing isn't about joining a fan base, it's about curating your mental diet. Because the ideas you consume daily quietly shape your financial future. Liking this video isn't about helping an algorithm. It's about reinforcing content that slows you down instead of winding you up. And now, the most important action. Send this video to one person. Not someone who wants to argue. Someone who wants to think. Someone you trust. Someone you've had late-night conversations with about money, stress, or doing things right. This isn't a video to win debates. It's a video to start better ones. And if you leave a comment, don't say, "Great video." Say something real. One belief that shifted. One assumption that cracked. One question you're still sitting with. Those comments don't just help this channel, they shape what we build next. This project isn't about telling you what to do with your money, it's about giving you back something far more valuable. Agency, thanks for watching. Thanks for thinking.
And welcome to a smarter, calmer way to deal with money.